Again, my view is inflation, or kind of the house view is inflation is going to be persistently higher. And that can happen in the very short term, like literally weeks. And I think the structural forces have changed.
Billionaire investor Bill Ackman just issued a warning about the future of inflation. But don't worry, it's not all bad news, and you'll see why during this video. For background, Ackman recently gave a rare, full-length sit-down interview. While this interview touched on a wide range of topics, it was Ackman's comments around inflation that really caught my attention. You're going to want to hear what he had to say. In this video, we'll explore Ackman's take on the economy, his reasons for believing inflation won't be going away anytime soon, and most importantly, how you can protect your money from the devastating impacts of high inflation. And by the end of the video, his practical strategy to make huge profits out of this situation. Let's dive in.
Are you still figuring that rates at the long end, the 30-year, for example, or however on the long end, are still going to go higher?
Yes. Look, I think there's, even in the relative short term, there are a number of reasons why rates can move a lot. Among them, right, we have a government shutdown. We're going into what looks like a highly probable government shutdown. We're going to have a data shutdown, right? All these little government agencies that put out data that the Federal Reserve relies on to decide whether to, adjust interest rates, then they're going to lose access to that data. So we're going to have this sort of like kind of dark period. We have probably the worst technical environment in our lifetimes for supply of bonds versus buyer bonds, right? We have China selling. We have Russia, to the extent they own any U.S. securities anymore, selling. We have Saudi Arabia selling. And we have an economy that is still strong, and inflation, 3.5%, 4%, and persistent. But, our view is basically you're not being paid enough to enter into a 30-year contract with the U.S. government at a fixed price. 4.7 or wherever it is now. It doesn't make sense in a world where we think structural inflation is north of 3% for the very long term. We went through this very unusual period with extremely low interest rates, where everything just got cheaper. And since the financial crisis, the effort of the Federal Reserve was to make sure we didn't have deflation. The aspirational goal is to get to 2% inflation, and then the pandemic, and trillions of fiscal stimulus, the psychological stimulus of being free to roam after being locked up. All of these factors coming at once kind of lit inflation, and we still have this massive deficit spending. We still have infrastructure spending. The government's selling literally hundreds of billions of dollars of securities, bills, and at some point they're going to have to sell more and more of the longer instruments. And if you look at the balance sheet of the Federal Reserve, it's an imprudent balance sheet. If you think about the United States, right? If this were like a business, you wouldn't have so much short-term. You wouldn't have a third or more of your debt repricing within the next year. So it's not been managed. I think actually Steve Mnuchin did a good job as Treasury Secretary. The one thing he missed is he should have issued a lot of 30-year, 50-year, 100-year paper at crazy low interest rates, and that's going to be a burden.
Hearing a lot from investors these days. Ken Griffin was on our network within the last week or so. I just had a conversation with Rick Reeder of BlackRock. Those who are talking about the possibility of much higher real rates for much longer than people think, for the very reasons that you're talking about. The issuance is so massive, and where are the buyers going to come from? And the result of that is going to be higher real yields.
I don't know about much higher real rates. I think again, my view is inflation, or kind of the house view is inflation is going to be persistently higher.
Well, you are the house.
But I guess I control the door on the way in and out, I guess. But our view is really that we're in a different world, and the world sort of changes gradually, and you have a generation of people who are used to rates 4 sounding like a high interest rate, and it's on a historical basis it's an extremely low rate of interest. So I would not be shocked to see 30-year rates well into the through the 5 barrier, and you could see the 10-year approach 5.
Jamie Dimon.
And that can happen in the very short term, like literally weeks. We've seen a huge move in the last number of weeks, and I think a lot of that is investors kind of rethinking. What's interesting about the 30-year Treasury is people reflexively buy it whenever they, because they've made money doing it in advance of a recession. But it's really not an instrument you should use to speculate on the short-term economy. It's a fixed price contract with the U.S. government for 30 years, and reflects really structural forces, and I think the structural forces have changed.
In the past few years, the rate at which prices have been climbing has hit a level we haven't seen in ages. To find a similar time, you'd have to look back to the early 80s. For a long time, the big talk was about how inflation was too low, with some even worrying about deflation, which means prices are dropping instead of going up. That might sound good at first, but it's actually not so great for the economy. Back in 2012, the Federal Reserve, let's call them the nation's money managers, set a goal to keep inflation at a steady 2% per year. Hitting this target proved harder than expected, and it led some people to believe that rising prices wouldn't be a big deal in the future. Inflation is really all about how much stuff is available versus how many people want it. If a lot of people want something that isn't available in large quantities, prices go up. For example, during 2020 and 2021, the government made it easier for people to have money through direct payments and low borrowing costs. This meant that more people had the means to buy things like used cars. At the same time, car manufacturers were struggling to get the parts they needed, so fewer new cars were being made. With fewer new cars, people kept their older ones longer, and the number of used cars for sale went down. This mismatch led to a spike in used car prices. Ackman, who's made billions, has a hunch that the prices climbing all around us aren't just a temporary thing. He's looking at the big picture and seeing a bunch of changes that hint at this. For one, the whole world's in a bit of a shuffle. Politically and economically, things are moving around in ways we haven't seen before. Also, it's getting pricier to make stuff overseas, which used to be a bargain. At the same time, people who work for a living are standing up for bigger paychecks, and that's changing the game too. Then, there's the big leap towards green energy, which isn't coming cheap. And have you seen the gas prices lately? They're so high that everyone's starting to think that digging deeper into our wallets might just be the way things are going to be from now on. Now, the Federal Reserve, those folks who try to keep our money worth something, might just keep cranking up the cost of borrowing money. They're hoping this will cool things down a bit on the price front. Sure, they've managed to get a grip on inflation for now, pulling it down from sky-high levels. But if Ackman's right, and prices stay stubbornly high, we might see those interest rates climbing even higher. That's a situation that usually makes investors nervous and can send the stock market on a bit of a roller coaster ride. Ackman, though, he's not sweating it. He seems to think that, like everything else, we'll adapt to this new money landscape. Take a listen.
You must be negative to the equity market. I mean,
No.
how could you have a positive view of stocks if you think that that's the outcome for bonds and yields?
Because if you own high quality, the key is owning businesses that have pricing power. Businesses that can do well in a world of, and by the way, many businesses can do well in a world of 3% inflation. The key is it's hard to manage a business in a world where inflation is volatile, or inflation is 8%, or the kind of crazy numbers. But many businesses can do very well in a world of 3% inflation. And the kind of companies we own, they're very much like royalties. So we own Universal Music, which is a royalty on listening to music. If there's music playing out there, Universal's getting a fraction of a penny for every song, that's being streamed. Google's a royalty, if you will, on people advertising, on the web, right, or on YouTube. Restaurant Brands is a royalty on people eating at Burger King or any of their various concepts. Hilton is a royalty on people staying in hotels and eating and drinking and going to events. The beauty of these kinds of businesses is, actually inflation is ultimately their friend, right? As long as they can keep their costs, as long as their costs don't inflate as quickly as their revenues. And I think the nature of those, so I feel comfortable owning those kinds of businesses, even if inflation remains high. And also, again, historically, if you think about, what is the value of a business? It's the present value of the cash you can take out of it over its life, discounted back at an appropriate interest rate. We were not discounting businesses back using 2% as an appropriate rate of interest. So we've historically, our discount rate we've used, just rough measure is more like 10%, 9%, numbers which discount the uncertainty inherent of investing in equities.
Let's delve into the stocks Ackman holds to understand practically what his strategy is to make huge profits out of this situation. Surprisingly, his hefty $1 billion investment fund is spread across only 7 companies. It appears as 8 stocks due to his investments in 2 different classes of shares in Alphabet. His selection includes a mix of eateries such as Chipotle and Restaurant Brands International, the umbrella for Burger King, Tim Hortons, Popeyes, and Firehouse Subs. He's also invested in the hospitality giant Hilton, the home improvement retailer Lowe's, the real estate firm Howard Hughes, the railway operator Canadian Pacific Kansas City, and Alphabet, which is the parent company of tech giants Google and YouTube. After a thorough analysis of the companies in Ackman's portfolio, 2 key characteristics emerge that enable these firms to not just withstand inflation, but potentially benefit from it. In fact, some of Ackman's picks might even see better performance if inflation rises. First up is pricing power. This is the ability of a business to hike prices without losing customers. Take Canadian Pacific Kansas City, for example, a railway company that Ackman has invested in. Given its essential service of transporting goods over long distances, it's often the go-to option over costlier truck deliveries. This leverage allows them to charge more if necessary. Chipotle is another of Ackman's choices that has shown robust pricing power. The chain has cultivated a dedicated customer base that didn't balk even when menu prices went up during peak inflation times. Warren Buffett famously said that if you can raise prices without losing customers, you're onto a winner. But if you have to agonize over even the smallest price increase, that's a business with problems. The second feature to look for is what's known as an asset-light approach. These are companies that don't need a lot of expensive physical assets to function. To put it into perspective, consider the airline industry, which is on the opposite end of the spectrum. It's very asset-heavy. For instance, American Airlines had around $40 billion in aircraft, a value that dwarfed the company's total market value at the time. On the other hand, look at Restaurant Brands International, RBI, another of Ackman's choices. RBI runs a franchise model where they don't have to own the physical restaurants. Local franchisees do. RBI simply collects a fee, often a portion of the sales, without the heavy costs of property and equipment. This setup makes the RBI largely resistant to inflation. In fact, as prices and sales increase due to inflation, RBI's earnings from franchise fees could rise without incurring additional costs. Ackman's investment strategy is to focus on businesses that act as royalties in their industries, reaping benefits as the industry grows and navigating through inflation efficiently. Whether his insights on inflation and interest rates will hold true is yet to be seen. However, with billions in investment success, Ackman's moves are worth watching for any investor aiming to sharpen their strategy. Thanks for watching. Subscribe for more weekly investment tips. Leave a comment below. Happy investing!